Developers who build low-income housing will continue to be exempt from real property tax payments if a draft bill approved by the Senate Committee on Finance makes it through the remaining legislative steps. The USVI housing sector is plagued with a host of issues, from high construction and operating costs to limited infrastructure to high insurance and utility rates. To combat these challenges and to improve the prospects of long-term retention of low-income housing access across the territory, the draft legislation would provide tax credits for developments built or renovated for the purpose of providing low-income housing. The credits would accrue to developers who have agreements with the government through the Housing Authority and Housing Finance Authority. In her presentation, Senator Donna Fred Gregory made sure to note that this exemption would not reduce government's tax revenues, as the developers affected by the extension in large part already qualify for tax-free status. The Low-Income Housing Tax Credit Program requires a developer to restrict rental fees for at least 20% of the housing units built for occupants who fall below half of the median gross income in their area. Otherwise, 40% of the occupancy rate has to be rent restricted and offered to tenants whose incomes are less than 60% of the median gross income in their area. According to the draft bill currently before legislators, the units should remain low income and rent restricted for at least one 15-year term, with the option to renew for a second. Once all requirements are met, there will be the possibility of continuing with the program after 30 years, or the developer can choose to no longer operate the property as an affordable housing community, raising unit rental rates to full market price with no income stipulations for residents. However, the hope is that the extension of the tax-exempt period, which was originally just 15 years, will stimulate new development for low-income housing.
Simply put, investors receive a reduction in their tax liability in return for providing affordable housing to people with fixed or lower income levels. And there are very specific requirements as to the number of units that must be rent restricted or occupied by people below a certain medium income size. By having the property tax abatement continue indefinitely, you're going to have eliminate incentives to sell the property, to raise the rates, to take it out of the affordable housing stock. So I think this bill is critical in that regard, and also helps, financing, encourages investors in housing stock.
Executive Director of the Virgin Islands Housing Authority, Robert Graham, also supported the bill, saying that the authority would also need to rely on the tax credit program in order to implement its plan to replace 3,000 obsolete public houses. Dana Clendenin, Interim Executive Director and Chief Disaster Recovery Officer at the Housing Finance Authority, said the LIHTC program was used to develop the majority of those added to the territory's inventory of affordable rental housing units over the past 3 decades.